This chart shows forward versus money market hedge. As you see in here, the money market hedge is on this red line, and the forward hedge is on this purple line, and forward hedge at all exchange rates performs better than the money market hedge. So now let's consider the options. As I indicated earlier, the first option with 1.75 strike has a premium of 1.5%, and the exercise put with this strike 171 has a premium of 1%. So let's consider both of these options and to see if they offer any better chances than the forward and money market hedge. So let's start with the 175. So if you use the 175 strike option, you'll have to pay 1.5% of 1 million, which is 50 million pounds premium. And if you convert this at the spot rate of 1.7640, which is the spot rate at the time that we would purchase this option, so that is $26,460. That's the dollars that we pay at the time we purchase the option. But at the expiration, if we consider the time value of this option at the cost of capital of the firm, at the time of expiration, the money time value of this option premium is $27,254. We do this calculation simply to be able to effectively determine the amount of dollars that we are going to clear from the exercise of this option, because we are making this payment at time zero, but the option is exercised, or the pounds are sold 3 months later. So in order to be able to do an apples to apples calculation, you need to convert this time $0 into the 3 months later dollars. So that's why we will have to do this time value correction in here. Similarly, the 171 option, which costs 10 million pounds, would in dollars at the spot rate cost us 17,640. Its time value in 3 months is 18,169. So these are the option premium cost time values of the premiums that we paid at time zero that will have to be factored in to figure out what would be net clearance from the option exercise. So if you look at the 175 option, assuming that the spot rate is below 175, we will exercise the option. So if we exercise the option, we're going to factor in the premium cost. The net amount that we would clear if we exercise the option would be 1,722,746. So for any spot price that is less than 175, the amount of dollars that we are going to clear is going to be 1,722,746. If the spot rate is above 175, we will not exercise the option, go to the spot market and sell pounds in the spot market. But since we pay this premium up front, we will still have to consider that. Obviously, in those cases, we are going to clear larger amounts than 1,072,746. So maybe graphically we could represent this here. So up until 175, exercising the option will give us 1,722,000. But at any point above it, we will be able to clear larger amounts. For instance, at 176, the amount that we're going to clear is much larger than 1722, and at 177 or 178, the amount is going to grow. So the put option with 175 strike gives us a minimum of 1,722,000, and there's some change in here, $746. But it can offer you better prospects, given that provided that the exchange rate turns out to be larger than 1.75. Now, it is important to note that the put option at 175 break evens with the forward contract at the spot rate of $1.7813. So that is what this means is that up until the spot rate reaches to 1.7813, forward contract actually offers more dollars than the put option would offer you. So, but if the spot rate is at 178.13 or above, and particularly if it is above 1.7813, put option actually will provide you more dollars as compared to the forward contract. That's actually what we're talking about, the upside. So in the case of put options, since we are able to take advantage of the upside, meaning that at any spot price above 175, this upside actually becomes even more valuable once the spot exceeds 178.13, because after that point on, put option actually offers a better prospect than the forward contract. So the 175 strike option at the minimum provides us 1,691,000. That is, given that the spot rate is below 171 and we exercise the option, as you see, we get 1,691,831, which is not good, because if we encounter this situation, and if we have to exercise the option, we will clear an amount that is not going to keep us about $1.7 million. So in that sense, although this option is cheaper, it does not give you sufficient downside protection to close the deal with profit. So in that sense, despite the lower cost of 1.71, given the risk of not cutting the $1.7 million line, we should not consider this option. So maybe I should quickly elaborate on this break-even point that we could show how we can calculate that. So in order to be able to calculate the spot rate that would break even with the forward contract, we will try to figure out at what spot rate the dollars that we clear from the option would be equal to the forward contract price that we 1,754,000. So we set up the equation in such a way that at what spot price the amount that we clear from the option, which is actually spot price times the underlying amount minus the option premium, that should be equal to 1,754,000. So if we solve this equation for S, we are going to get so 1,754,000 plus 27,254 divided by 1 million pounds. The amount that satisfies this equation is going to be 1.7813. So this is the break-even point. And now we can calculate the break-even point is simply setting up this equation and solving this for the S. So for this spot rate, for 178.13, the option and the forward contract offers the same dollars amount, but at any price above 178.13, the put option is going to be a better prospect. So let's clear this and move on to the next slide. As you see in here, we have the representation of 175 put option. Here, 171, which actually fails us at the bottom, at the lower end or downside, where we cannot clear the required 1.7. As you see, if we draw a line on 170 for the spot rates that are below 171, we are not going to meet the requirement. So these are two options in comparison. Obviously, the lower cost of the 171 shows up in here, but again, the amount that we clear is not sufficient to go above the 1.7 million that is required. So in comparative analysis, the forward contract offers us 1,754,000. Money market offers us 1,746,790. The 175 put hedge gives us 1,727,452. Actually, if you enter into an at-the-money put option, which is the strike price at the forward rate, 1.754, we will clear 1,727,452. And if we use a strike price that is less than the forward 1.754, we could get this amount. So these are various alternatives. If you look at all of these, unless we think that the chances of spot price going about 1.75 is really strong, we should stick with the forward option. So forward actually gives us probably the better protection at the money. So I will stop this recording.